Well, we had that breaking consumer confidence data crossing the wire, coming in at 98. Economists were expecting 87.1, an increase from last month's reading of 86. I want to bring in my co-host for the hour, Simeon Hyman, ProShares global investment strategist. No relation, as we always say. Simeon and I have been doing stuff together for many years. And we have Eric Winograd, AllianceBernstein chief economist. Both of you guys, thanks so much for being here. Simeon's going to be here for the hour. Eric here to talk to us a little bit about some of the data we've been getting. So let's start with that consumer confidence reading, because it is interesting to see, and unusual lately, to see a survey that comes in stronger than estimated.
Yeah, it's nice to see a little bit of a rebound. We've seen significant weakness in a lot of the survey data, in the soft data, as you point to. And it suggests that consumers are at least somewhat sensitive to the news flow, the back and forth on tariffs. We got the back, if you will, and now with the forth, consumers seem to be feeling a little bit better about things.
And do you think that that is going to translate? There was concern on the downside of the survey data that it would translate into lower spending. But do you think there was actually going to be any significant change in spending, or do we just go back to status quo at this point?
So, look, the correlation between the hard and the soft data is imperfect, right? It's not perfect. It's never been perfect. It's probably less perfect now than it would normally be. I think we also want to take a step back and look at this in perspective. Consumer confidence indicators are still lower than they were a few months ago. They're, again, back and forth, but generally trending lower. This is also only one measure of consumer confidence, and some of the others look a little bit weaker. So we do think still that the soft data are sending a leading signal about where the hard data are going to go over the next few months. We do expect a slowdown in consumer spending.
Eric, what if we get back down to this 10% thing that's supposedly the floor? Is that enough to have a material impact long term? Let's assume all the other crazy stuff doesn't happen, but the 10% sticks.
Oh, I think that's enough to have an impact. It's an interesting perspective to put on it. If I had told you coming into the year that we were going to have a 10 percentage point increase in the universal tariff plus some additional stuff on China, I think most people would have thought of that as a very bad outcome. It's only because we have seen worse that all of a sudden doesn't look so bad. Is that enough to crater the economy, to push us into a recession? Probably not. But it is enough to have a meaningful impact on both growth and on inflation.
And so what is that impact? If 10% is the baseline, if that is where we end up, how should we be thinking about that?
So that probably pushes prices up by about 1% for the economy as a whole. If you otherwise would have had inflation at 2.5%, you probably now get it more like 3.5% or something like that. In our estimation, that's enough to slow growth down by give or take 0.75 percentage point. We have been assuming over the course of this year that the effective tariff rate increase will be about 15 percentage points, which is, call it a 10% universal plus 25% or 30% on China. That raises prices by 1.5%, and it slows growth down in our forecasts to about 0.5% for the year.
So if that's the case, when can we look to the Fed to when can the Fed be sure enough that that's going to be the outcome, that it can actually move?
So the Fed has been clear here that they're going to rely on the hard data, not the soft data, and particularly the labor market data. Remember that their mandate is the labor market, not growth in general. It won't be until we see true weakness in the labor market that I think the Fed will be comfortable moving. Minneapolis Fed President Kashkari this morning was only the latest Fed president to signal that they're going to wait and see how things play out. I think that that's the message they will all deliver until we get 1 or 2 weak payrolls reports, and then they'll be ready to cut, in my estimation.
If you look at consensus forecasts, you got 2 cuts this year, 2 cuts next. So you got 3.5 or so on Fed funds, but only 4% on the 10-year. To me, that seems a little flat. What do you guys think in your shop?
So we're concerned about the 10-year and the 30-year in particular as it pertains to the fiscal position, and that makes it much more difficult to forecast them. Normally you would look at the business cycle, you would have an expectation for Fed policy, and that would guide you to your 10-year forecast. But with fiscal policy in play, with the one big beautiful bill under discussion, there's no evidence of fiscal restraint, and if anything, we're seeing additional fiscal deterioration. And as a result, we expect the yield curve to steepen. We think that longer dated yields are going to be sticky, that it's going to be hard for them to come down the way they normally would during a rate cutting cycle.
And so how do you think about the economic impact if indeed we're going to see that 30-year yield higher?
The long bond yield and the 10-year yield matter a lot more than the Fed funds rate to the real economy. There are a lot more prices that are indexed to those longer yields, mortgage rates being only the best example. And So it makes it more difficult, in a sense, for the Fed to ease policy if you have interest rates not respond further out the curve. Simeon, you mentioned what's priced into the market now. When I look at what I think of as mispriced, it's the cuts next year, right? The idea that the Fed is somehow going to deal with an economy that is slowing and not cut beyond neutral, right? That they're still going to have a policy rate that's in restrictive territory, and that's going to be enough to stabilize the economy even while long yields don't come down. I'm skeptical of that. So in our forecasts, we have more easing next year. We have a total of 6 or 7 rate cuts as opposed to the 3 or 4 that the market is pricing over the next 18 months or so.
And then, but if that's the case, is the Fed sort of combating the effect of rates staying sticky? And then if they cut further, are there risks to that?
Absolutely. Look, there are risks, and one of the risks is if the Fed is cutting while fiscal policy is easy, you have them both pulling on the same end of the rope, and you do start to worry about long-dated inflation expectations. You worry about whether the market will assume fiscal irresponsibility and monetary policy accommodation, especially as we move into the period where Chair Powell's term expires and where President Trump will be able to appoint a new Fed chair. If there is concern that the Fed is cutting not because they need to, but because the political side is telling them to, the whole situation looks very, very different.
The downgrade, de-dollarization, is that in the mix of how you guys are looking at the yield curve?
It is, absolutely. I don't care very much about the downgrade, right, in the sense that we've seen the U.S. downgraded before, and honestly, if the U.S. is not AAA or whatever, it doesn't make any difference in terms of the way that investors behave toward it. Treasuries are still perceived as the risk-free asset off of which other assets are priced. If that changes as a result of de-dollarization, things again start to look very different. It's a classic finance dilemma in the sense that the probability of de-dollarization is very low, but the consequence of it would be very high. And it's not at all clear how investors are supposed to protect themselves or to position for that. But yeah, absolutely, that's in the firmament, and it's a topic that we're going to hear a lot more about, particularly as we work through this budget negotiation.
Well, okay, so let's talk about the budget negotiations to leave off our chat here. On balance, is that bill good or bad economically? I know good and bad are very broad terms,
yes.
But how are you assessing it from an economic perspective?
So from an economic perspective, what we would say is the following. It is likely to expand the deficit. We are already running the largest budget deficit we have ever run outside of a war or a recession. There's nothing in that bill that suggests any sort of fiscal restraint. If anything, it is likely to expand the deficit. I think most people would agree that at a time when the economy has been performing well, you would like to see fiscal consolidation. You would like to see the deficit going the other way, but we don't. There are things that from a business perspective will be welcome in the form of tax cuts and so on. Those are being used, however, to offset, the offset to those is, the spending cuts that are in the bill are being used to offset tax cuts rather than to consolidate the budget position. I think most budget analysts would prefer to see some sort of consolidation, but with Congress completely unwilling to consider tax increases or revenue increases, you're left in a position where it is very difficult to see fiscal discipline. And to be honest, the only force that is likely to force that to happen is the bond market. We've talked and you've heard about bond vigilantes resurfacing. I don't think they really have yet. But unless and until they do, I don't think the political side in either party is likely to do what is necessary to reduce the deficit.
Well, that certainly has been true thus far.
Yeah.
And there's no signs that that's changing. Eric, thank you so much for coming in. Appreciate it.